Marvell Technology is an interesting stock to consider for investors looking to capitalize on the rising effectiveness of artificial intelligence. So in this video, I'm going to review Marvell Technology, its revenue, its cash flow, its valuation, its prospects over the next couple of years, and answer if this stock is a buy for long-term growth stock investors. So let's jump in. Let's take a look at this interesting stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Marvell Technology, its stock price has been volatile since 2022, but if you look back longer term, it's on a nice upward trend. The stock price is still down from the peak valuation just before 2022, although it has been rising nicely so far in 2023 and early 2024. Marvell Technology trailing 12-month revenue over the last decade has been cyclical to be sure, and it's on a downtrend in the most recent trailing 12-month, reaching $5.5 billion as the company suffered from the decrease in demand for personal computers. Remember, lots of people bought personal computers in 2020 and 2021, and that's led to a slowdown in computer sales in 2023, because when you buy a computer, you don't replace it every year or even every other year. Very likely the average is between 4 to 6 years replacement cycle. So that part of its business, even though it's not the only part of its business, but that part of its business decreasing as much as it did hurt Marvell Technology revenue in the latest trailing 12-month period, although things are expected to improve over the next couple of years for Marvell Technology, as I will show you in just a little bit. Similarly, its operating profit margin over the trailing 12 months have been volatile. You can see it falling to below 25% and then rising to 20%, falling back down, rising up before ending at negative 7.31%. So no real trend either upward or downward for Marvell. All you can say about its operating profitability is that it's been volatile. It's been up and down. Now let's look at the importance of cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that you have a better understanding of the importance of this metric and how it differs from profitability, you can see Marvell demonstrating positive cash flow from operations 21.37% in the latest trailing 12-month period, much better than its operating profitability. And you can understand those reasons now that I shared with you the details of cash flow from operations. Looking forward, Marvell Technology 2023, I mentioned, is not going to be a good year when it's all said and done. 7.1% decrease in revenue expected and 28.6% decrease in earnings per share. Although things are expected to turn around. 11% revenue growth expected for Marvell in fiscal year 2024 with 33% earnings per share growth. And in fiscal year 2025, it's going to get even better. 20% revenue growth expected and 40% earnings per share expected. So the next 2 years are expected to be excellent years for Marvell. And you're seeing something that I really like to see in an investment, and that is the second derivative growth here, the increase in the rate of growth. You have 11% growth in 2024 and 19.9% growth in 2025. So the rate of increase is increasing. Not only are they growing by double digit or expected to grow by double digits, but that rate of growth is expected to increase. Same thing with earnings per share, 33% expected in 2024 and 40% expected in 2025. 33% earnings per share growth is excellent, but to increase that again, the rate of growth again in 2025 would be really, really good. So top and bottom line, second derivative growth expected for Marvell Technology. This is something I value greatly when considering an investment. Finally, I wanted to consider Marvell's valuation. I'm looking at its forward price to earnings ratio, and it's currently trading at a forward PE of 25.19. It's about its average price going back the last 5 years or so, according to this metric. You can see there were moments when the stock traded at a more expensive valuation. In 2022, it reached above 50 in terms of forward PE, and there were moments where it was trading at a lower valuation, closer to 16 or 17 here in 2023, and closer to 14 or 13 in late 2020. So it's had its moments. Right now, it's at about its average valuation, its fair valuation. Although given its excellent prospects that are expected over the next couple of years and beyond for that matter, I expect Marvell to benefit from the rising effectiveness of artificial intelligence. Marvell also benefits from the rising demand and rising investments in driverless car technology. That's another area that's data intensive that Marvell helps support, and that's an area that I think will increase in investments, not in the next year or two, but perhaps in the next 4 or 5 years. So that's an area that Marvell investors can be enthusiastic about too. So all things considered, its prospects, its valuation, its revenue, its expectations, I would say yes, Marvell Technology stock is a good stock to buy for long-term investors. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.